What is operating cycle? Operating cycle is the process and time needed for cash to turn back into cash. The operating cycle consists of two: the single-step income statement and multi-step income statement. In a single-step income statement, the service industry is a good example. From service revenue, we deduct expenses to get the net income. As simple as that. In a multi-step income statement, the merchandise industry is a good example. From net sales, we deduct the cost of goods sold. The cost of goods sold is computed using either a periodic or perpetual system of inventory. Then we deduct expenses to get the net income. Here is an illustration flow of a single-step income statement. We deduct expenses from service revenue to get the net income. While multi-step income statement flow starts from net sales less the cost of goods sold, to get the gross income. Then from gross income, we deduct expenses to get the net income. I don't see any difficulty in service, single-step income statement. Merchandise, multi-step income statement is challenging. Question: what is net sales in a multi-step income statement? Answer: it is the sales less discount, less sales return and allowances. Here's the illustration of how net sales works. Sales: a debit to cash or accounts receivable, and a credit to sales. Sales discount: a debit to sales discount and a credit to accounts receivable. Sales return: a debit to sales return and allowances, and a credit to cash or accounts receivable. Question: how to get the cost of goods sold? Answer: it depends on the inventory system used by the firm. It is either a periodic, at the end, or perpetual, real-time, inventory system. Let's go to the comparison. Periodic system versus perpetual system. Here's the formula to get cost of goods sold. Beginning inventory balance, add net purchases, less ending inventory equals the cost of goods sold. Note that we have the same formula in getting the cost of goods sold. This illustration shows the process and time difference of the two systems. In periodic system they do physical count at the end of the period, the difference between beginning inventory including net purchases, and remaining inventory as the cost of goods sold. While in perpetual system, they record continuously the details of every purchases and sale on a real-time basis. Question: what is net purchases? Answer: it is the total amount of purchases, less purchase discount, less purchase return and allowances, add freight charge delivery cost, equals net purchases. Here's the illustration of freight charge. In FOB free on board shipping point, the buyer pays the freight charge and the buyer owns the goods in transit. Once the goods leave the seller warehouse, the ownership is transferred to the buyer, meaning, whatever the damages or loss while the goods are in transit, the buyer will bear the loss. While in FOB free on board destination, the seller pays the freight charge and the ownership is transferred to the buyer once the goods are delivered, meaning, whatever the damages or loss while the goods are in transit, the seller will bear the loss. Finally, I'm done with the accounting cycle versus operating cycle. Like, share, and subscribe.